Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all these confusing corporate documents. This week we are digging into the Federal Home Loan Bank of Atlanta's latest quarterly report, and let's just say they have a lot of numbers to play with. Their total assets have grown to over $153 billion. That is up 4.6% from the end of last year. Now, where is all this money coming from and where is it going? Let us dive into the financial tables to see the story behind the money. Okay, so looking at the statements of condition, the bank's total assets hit $153.8 billion as of the 30th of September this year. This is a pretty big number, and it mostly comes from the bank lending money out through advances. Those advances grew by more than $8.3 billion. It's like they are handing out loans left and right. On the other side of the coin, their liabilities also went up by about $6.2 billion, reaching over $145 billion. A huge chunk of this is from consolidated obligations, which is basically them borrowing money in the capital markets. They owe over $141 billion through these obligations, which shows they are really leveraging their borrowing power to fund all those advances. Now, for the really interesting part, their total capital increased by $556 million. This capital acts like a buffer. The bank's total capital now stands at over $8.4 billion. This growth is largely driven by more capital stock being issued, which means more members are putting money into the bank and also an increase in retained earnings, meaning they are keeping some of the profits instead of paying it all out. This looks healthy, showing a growing equity base to back up their operations. Let's talk about investments. The bank holds over $33 billion in investment securities. This is a mix of available for sale and held to maturity securities. While the overall investment portfolio grew, there was a notable shift. They actually decreased their holdings in securities purchased under agreements to resell by a whopping $14.7 billion. This is a pretty aggressive move, likely to redeploy that cash into other areas like those growing advances. Now let's look at how they are making money. For the 9 months ending in September, their net income was $439 million. This is down from last year by about $82 million, a decrease of nearly 16%. The main reason for this drop is net interest income, which is the difference between what they earn on their loans and investments and what they pay out on their borrowing. This earned income decreased by $85 million compared to the same period last year. The decrease in net interest income is mainly because of lower interest rates. Think of it like this: if you loan money out at 5% and rates drop to 3%, you are making less even if you loan out more money. The bank did loan out more money, as we saw with those rising advances, but the lower rates had a bigger impact. One interesting item here is voluntary housing and community investment expenses. For the first 9 months of this year, they spent $37 million on this, a slight increase from last year. This is part of their mission to support communities and affordable housing, which is a nice touch beyond just making money. Their return on average equity, a measure of how well they generate profit from shareholder investments, dropped significantly. For the first 9 months of the year, it was 6.73%, down from 8.29% last year. This lower profitability combined with the increase in their equity base means they are generating less profit relative to the money invested. So while they are growing, the profitability per dollar invested is lower this year. Looking deeper into advances, we see most of them are now variable rate, around 64% compared to about 57% last year. This makes sense if they are trying to manage interest rate risk. If rates go up, they can adjust their borrowing costs faster. They do use derivatives to swap most of these fixed rate advances into variable rates, effectively dodging some of that interest rate unpredictability. In their investment portfolio, there was a big jump in interest, bearing deposits and federal funds sold totaling over $25 billion. This suggests they are keeping a larger portion of their funds liquid. However, they also reduced their holdings in securities purchased under agreements to resell by nearly $15 billion. This is a significant reallocation, probably to fund those growing advances and perhaps to invest in more stable assets. Their consolidated obligations jumped up by $5.7 billion. This indicates they are borrowing more to fund their operations, which aligns with the growth in advances. Notably, a large portion of their fixed-rate consolidated obligation bonds are swapped to variable rates. This is a common strategy to manage risk in volatile interest rate environments. Now let's briefly touch on risk management. They have a pretty extensive system in place to manage credit risk, which is the risk that borrowers won't pay back loans. They rate their members on a scale of 101 to 104, with 101 being the least risky. It seems most of their borrowers are in the best rating categories. They also require collateral for advances, which is a smart move. The collateral here is mostly first mortgage loans, which helps secure their lending. A key takeaway is that they have never experienced a credit loss on an advance in their history, which is impressive and speaks to their rigorous collateral requirements. Their use of derivatives is pretty extensive. They mostly use interest rate swaps to manage risk. The notional amount of these derivatives is over $116 billion. This is the face value used for calculations, not the actual amount exchanged. They are using these swaps to convert fixed rates to variable and vice versa to better match their assets and liabilities and reduce exposure to interest rate changes. When it comes to fair value measurements, they classify assets and liabilities into 3 levels based on how observable their prices are. Level 1 is for quoted prices in active markets. Level 2 uses observable market data like interest rates, and Level 3 uses unobservable inputs. They reported no level 3 assets or liabilities, meaning all their fair value measurements are based on observable market data, which is generally a good sign of transparency and reliability. In terms of legal matters they mentioned, they may be subject to various legal proceedings, but do not expect any of them to materially impact their financial condition. This is standard boilerplate, but reassuring nonetheless. So what is the story here? The Federal Home Loan Bank of Atlanta is a robust institution showing strong asset growth primarily driven by lending to its members. They are effectively using borrowing and derivative strategies to manage interest rate risk. While net income decreased this year due to lower interest rates, their capital base is growing, suggesting a solid financial foundation. The business seems to be on solid ground. Alright, that is our breakdown of the Federal Home Loan Bank of Atlanta's latest filing. Your thoughts on these numbers and what they signal for the company's future, let us know in the comments. If this analysis was valuable, hitting that like button really helps, and of course subscribe for more deep dives. And don't forget to check out our Discord community linked in the description below for more discussions. Thanks for watching, see you next time.